You can't actually buy the S&P 500, not directly. So, what are you actually buying? How do you go from zero to owning a piece of the market? What's really inside an index fund? And what does it cost you? Let's open the machine. Hello, welcome to ArashInvest. Last week we asked why you should invest. Today, how. First, how do you actually buy anything? You need a brokerage. A brokerage is just a platform that allows you to buy investments. It could be your bank or it could be a dedicated investing app. You open an account, you add some money, you find the thing you want, and you click buy. That's it. Now you own a piece of the market. And here is the good part. You don't need to buy a whole share. Most brokerage let you to buy a fraction of one. So the price is never the wall that people think it is. You can just start small. So what should you actually buy? Think of a box of chocolates. One box, all the dark chocolate. You don't like the dark chocolate? Bad box for you. Now a mixed one. A little of everything. One piece you don't like, it doesn't ruin whole the box. An index fund is the mixed box. That's the whole idea. Instead of picking one company, you buy a piece of everything. Now I'll be honest with you. I started with indexes. Lower risk and easier to understand. A good place to start. Over time, as I learned more, I started adding individual stock on top. I still hold ETFs and a small position of S&P 500 and one Nasdaq 100. But now I also pick some stocks myself. That's a later step. For today, let's start with the foundation. Let's open it up. What is an index fund really? First, one important thing. You can't buy the index itself. An index like S&P 500 is just a list of 500 companies. You can't buy a list. So you buy a fund built to copy it. And most of the time, that's something called an ETF. One more thing if you are living in Europe. Look for the word UCITS in the fund's name. It just means it builds for European investors. But it still copies the same index. Okay, so how does one fund hold 500 companies? It buys them, all of them, in one basket. When you buy one share of that fund, you own a tiny slice of all 500 companies. But not equal slices. This part is important. Look at the top list. You see Nvidia, about 7% of whole the index. One company. Now let's scroll down. Another one down and down. Now here the bottom of the list. Paramount Skydance. Do you recognize the company? Maybe. Because it's one of those big streaming companies in the world. It only has 0.01% of whole the index. And by the way, you may recognize that actually is not 500. You see 503. That's not a mistake. Let's go up and I'll show you. Some companies has two types of shares that you can buy, like Alphabet, the mother company of the Google. As you can see it here, Goog and Google. So that's the reason for that 503 instead of 500. But still, it is only 500 companies. Same fund, same 500 companies. But one of them moves the whole thing. And one of them, as you see, barely exists. This is called market cap weighting. The big companies take up more space. The small one, almost none. So when someone says the whole market, this is what they mean. Not one company, instead hundreds. Weighted by their size, so no one sits here to pick the winners. The fund just copies the list. That's why it stays simple and cheap. Now, let's be honest with you about something. Right now, the biggest companies take up a lot of space. The top 10 alone, as you can see, it's more than a third of whole the market. And some investors think that's gone too far, that it is no longer as spread out as it looks. That's a real debate, and I'm not gonna solve it today. But you should know that exists. So you're not going to be surprised later. Which brings us to the last question. What does it cost you? Every fund charges a small fee every year. It is called TER, total expense ratio. Now some people hear fee and panic. Do not please. For a normal index fund, anything under 0.5% is totally fine. Most of them are way lower than that. Look at this chart. These are the biggest S&P 500 ETFs in Europe. The most expensive one here, look, it is only 0.07%. A little bit down the cheapest. It is 0.03. That's it. That's the whole range. Very tiny. And now a quick note for the names. You may see ACC and DIST in parentheses. ACC is standing for accumulating, which means the dividend get reinvested automatically by them. DIST stands for distributing. That means they get paid out to you in cash. That's the whole difference. Do not overthink it right now. And also look, the biggest one at the top list is not the cheapest. Popular doesn't mean cheap. I'll be honest about my own money here. I started with the Vanguard one, accumulating. Then when I understand fees better, I sold it and moved everything to the cheapest one, the SPDR. But be careful with that. My position was small. I didn't pay any tax to switch. If you already own a good fund and you would pay tax to move, it's probably not worth it. The difference is small. But if you're starting fresh, start with the cheap one. One more thing, there are ETFs for other indexes too. Europe, the whole world, tech, and so on. Some cost a bit more, and some other cost the same. The S&P 500 one just happened to include the cheapest one. Okay, what is the fee that you should be worried about it? Anything above 1%. That's when you ask, why I'm paying so much? But yearly fee isn't the only cost. Some brokers also charge a fee for buying, sometimes a flat amount, sometimes a percentage, and others charge nothing. Worth checking before you click buy. And here is why it matters. If you buy 100,000 euros at once, a flat fee is nothing. But if you have only 100 euro and you want to invest it, that same fee eats a much bigger bite. So size matters. Personally, I picked a broker that doesn't charge this. It's out there. You just have to check before you sign up. One more cost, the hidden one. When you buy, the buy price and the sell price are not always the same. That gap is called the spread. Some brokers says zero commission, but a wider spread can cost you more than a fee ever would. So check both before you choose, the commission and the spread. The total cost is what matters. Of course, there is a lot to talk about the costs, spreads, taxes, and fund structures. If there is something you want me to go deeper on, write in the comments. I read them, and it shapes actually what I cover. So that's the machine. You open an account, you buy a fund, the fund holds the whole market, and you keep your cost low. If you haven't seen the last video yet, I would start there. It explains why any of this matters before you touch a single fund. If you want to understand money the way nature understands survival, this is your channel. Like, subscribe, and I'll see you in the next one. Bye.